We're checking out whether there's a key turning point in the Japanese yen coming up. And then we're going to focus on the EU again. France has been placed on a fiscal watch list. What does that mean for geopolitical instability within the bloc? And the trading takeout today is going to be why you need to get rid of all the different colors on your chart. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So we've got an interesting occurrence here in the yen, and I'm looking specifically at the Swiss franc versus the Japanese yen here, purely because of the weird monetary policy that both economies exhibit. So at the moment, what we're seeing is, or what we have seen, is the Swiss franc rally horribly against the yen. The yen, as we know, has been considerably weaker than all other currencies over the past 2 years. Well, maybe even longer than that, especially against the Swiss franc, 3 years, say. And this is predominantly due to, how easy the Bank of Japan has kept policy. They've kept QE going for a very long time now, nearly 20 years, well, over 20 years, in fact. And even after this inflationary tick up globally, they still have kept it relatively easy. They've recently made a slight change to the yield curve control, where they've made it a little bit more flexible, but still, it's not hawkish. And what we're also seeing is, with the recent GDP print, is that the Bank of Japan are now concerned, or at least they were concerned, about inflation ticking up higher, meaning that they might have to raise in spring. But the recent GDP print was actually negative. So they're not in a very, very strong place. And it's now coming down to whether growth or inflation is, the thing to target or combat. Now, the one thing to note here is that we might be returning to the yen being a risk haven, though. And you can see it already here. You can see how the yen has behaved against the Swiss franc through the month of November. We've traded above the previous month's high, October's high, and now we've really, really been selling off quite drastically. And what you'll notice here is I've got the yield differential between the Swiss 2-year bond and the Japanese 2-year bond. And we've obviously, the spread has increased massively through this period, but now we've tailed off. And I think that's very, very important, because what we're seeing is that differential is no longer increasing. It's showing that the Swiss National Bank are likely at the peak of their hiking cycle, like many other central banks are at the moment. Which, as I've said loads over the last couple of weeks, markets only really care about relative differentials, relative surprise. And so what they're pricing in now is the Swiss National Bank has priced all of their hikes in. Now perhaps that differential can come down, which means it's quite bullish yen. At the same time, if we were to take this off, we can also add in, if we were to have a look at TLT, which is a US bond ETF. You can't trade this as a retail client. And you can if you're a professional, but you can't trade it as a retail client, but it's a very good proxy for the overall longer duration bond market. You can see at the same time this has ticked up. So short Swiss yen at the moment is actually a proxy for being long bonds, which is why I think this relationship is so important at the moment. So you can take this two ways. You can take this as being, and in fact, if we were to look at UK government bonds, so VGov is a nice ETF, you can see the same relationship is there. Ignore that. That wasn't that wasn't advice. But you can see that the same relationship is here. We've seen a massive, massive uptick in bonds. So what this leads me to believe is that there is a regime change currently occurring, and it's in favor of the bond market. I think what we're seeing is that interest rates have indeed peaked, which is great if you're a variable mortgage owner. And also, perhaps if you are more tech-minded, if your portfolio is more tech-minded, and we can avoid any kind of liquidity or financial crisis, then that should be a support as well, if yields are to come down. But At the moment, this is the very, very early stages of a regime change, a macro regime change. Things can change, but we're seeing bonds across the board start to turn bid, which certainly signifies to me that something is going on. And so, yeah, I think the focus from here on in is to look at how FX pairs are now going to change trend drastically. Maybe you've got a momentum indicator that you favor. Maybe even moving averages are what you like to look at, but really focus now on those FX pairs that have been, especially in the yen, that have been really considerably weakened, and now maybe it's their turn to get a bit stronger. So are we seeing a repeat of 2010, 2011 with the sovereign debt crisis that kind of enshrined Europe at the time? It was a really, really tricky time for Europe. We saw Greece, Cyprus, lots of economies really get hit. The pigs, as you like to call them, Portugal, Ireland, Greece, Spain as well, Italy, just absolutely wrecked by the EU rules. There is in the EU some fiscal rules via the Stability and Growth Pact, and most notably it's called the excessive deficit procedure, where if you want to be a member, you have to abide by certain limits on government deficit spending as well as debt to GDP levels. Now, the thing is that the biggest countries there, France, Germany, have been breaching these rules for ages. Germany has 360 billion euros in special funds outside of the government budget. France, as you can see here, reporting by Bloomberg, they have been flouting the rules as well. Now, this is the problem with the composition of the Eurozone, is that really what should occur is there should be flexibility with interest rates between different economies, because an interest rate for Germany won't be the same as an interest rate for Portugal or Greece or pretty much any other economy. They're going to have to differ because the economies just are not the same. They have different exports, different imports, different demand, different supply, labor dynamics, you name it, it's all different, which is why it's kind of broken and why they can't just set unilateral rules for the whole block. It doesn't make sense. So it's structurally defunct in this way. What we are seeing here is the start of a return to austerity. Now, it might not be fully fledged austerity because there is a lot of rule flouting. Germany, as I said, they hold a lot of their debt out of the budget. And so, but there is a big but here. The German audit court has actually said that the government can no longer do this as well. So they've rejected 60 billion euros just last week, I believe, of green funding, basically, because they understand that they're basically flouting the rules and they just don't think it's right. Germany operates very much on a rules-based sort of culture and society. And this is creating big, deep rifts, I think, in the German government. Olaf Scholz came in 2 years ago now, and he's been a disaster. He's got the lowest ratings in Germany pretty much ever. He's got worse than Merkel during the peak of the COVID times. And I think, the way that this is looking is that there's going to be a showdown at some point. There's going to be a showdown at some point, and where it comes from, I'm not too sure, but we are seeing big problems in Germany currently with the rise of Alternative für Deutschland and other right-leaning parties. Even the Greens in Germany, the Liberals, are becoming more, not necessarily extremist, but more right-leaning. And so you can see this populist takeover, and it stems all from what's happening at central government with things like debt, the rules, how for so long Germany survived on cheap natural gas from Russia, and now they cannot do that anymore. So industry's wrecked there. And I don't necessarily see a way out currently. I think there's going to have to be a lot of pain. So in terms of how this looks for the euro, again, it comes down to that structural issue whereby EU rules supersede pretty much everything else. And the lack of flexibility means that the euro will have to come down. It's not about, if it will come down. It is have to come down, because if they want Germany, France, etc., to remain competitive, they're going to have to do that. And the way that it's looking currently is that deflation, as I mentioned yesterday, is coming into the picture. The easiest way to reinflate the economy is to cheapen the currency. So interest rates are going to have to come down. Now, if US interest rates stay higher while European interest rates are falling, that differential increases. Remember the Swiss franc, Japanese yen example. And so we're looking at a similar relationship there, whereby if the spread decreases, the euro is going to have to fall and the dollar strengthens. So time will tell, but I think that's the way that it's going. And this geopolitical instability will not do the bloc any favors. You'll notice on my charts that I use the black and white color coordination or appearance, whatever you want to call it. And there's a very good reason for this. And I think the best way to explain this is when you go into a casino, what are the colors of the tables? What are the colors that you see around you? What are you seeing constantly? And it tends to be green and red. Now, why is that? Well, it's because people associate green with good and red with bad. Or if you're in Asia, it's actually the opposite. Red is good and green is bad. But I don't want these associations to form anything subconscious in my head. I want to look at something and have to say to myself, oh, okay, all right, there's the open and there's the close. I don't want to have to go, all right, yeah, it's green, so that's good, that's up. I want to have to force myself to examine exactly what's going on the chart. And, you know, it takes me half a second these days because I just automatically understand it. But the fact that there's no emotional association to the colors, and it's very, very slight. This is such a slight sort of thing that you can change. But it adds up. If you're making constant little changes like this, where there's no association emotionally to things, then at the end of the day, it could save you one day from entering the market wrong or, you know, basically just doing something wrong. So these tiny little changes add up to things. And I think one of the easiest ones to do is to try and look objectively at the market. It's the same as when I say to try and use volatility stops so that you're not, you know, just throwing down a stop loss wherever you think is right rather than where it objectively should be. You want to remove subjectivity as much as possible because there's so much subjectivity that goes on in having a view that when it comes down to execution, when it comes down to everything else, you just want to get rid of that.